Ladies and gentlemen, Hugh Hendry presenting to you the acid breath on a Monday after a weekend where I caught up with a lot of sleep. They tell me it's the 27th of October. They tell me many things. The one thing they don't tell me today is what I can talk about. I'm not sure there's much I can say. Let's try. I'm going to start slowly. And heavens, I keep saying, this is walking a tightrope. Tonight it feels as if I'm traipsing, not through the graveyard, but between two very high buildings. Because I literally have nothing immediate to say. If you got nothing to say nothing. Let's see if we can disprove that. Economic releases. A joke. Actually, Monday, weren't we supposed to hear about a vote for reopening the government? I haven't heard anything. But it's a busy week. A busy weekend. And wasn't it nice to see Millet come through in Argentina? It just feels like our home team, my God, my hair, our home team, having suffered a lot of, what can we say about, what is the home team? I was going to say Ayn Randians, but come on, that's preposterous. Those who want markets and objectivity, less emotion, less prejudice, kind of cold calculations, allocations to decide how we spend other people's money. Millet, the travesty of Argentina, which was one of the richest countries 120 years ago. Harrods, the only Harrods that they opened outside London was in Buenos Aires. Go figure. Nice to see the US put money where its mouth is and say, we like this and we want it to continue. And it would seem the leak from the Treasury Secretary is the US seems likely to have extracted a grand bargain from the Chinese. I hope so, because we priced markets. Did markets gap higher today at the open? I'm of that superstitious generation that says every gap, especially if I buy above a gap, every gap gets filled. Do you know what a gap is? It's a price gap. It's where there's an interruption in the universe and the next trade is above where it closed the previous day. And so there's an unfilled vacuum where no volume traded at prices in between X and Y. I don't like that. My presumption would be that the US is capable of extracting a deal from the Chinese. Again, it comes back to this notion of the debtor versus the creditor that we've had 3 decades, if not longer, where everything has gone the right way for creditor nations. The debtors are those with a lot of energy and the ability to change and influence the direction of tomorrow, but looking for financing. That can be small enterprises, entrepreneurs, and then the creditor would be, if you will, the bank. No idea, but a repository of surplus capital. And the genius of our system is we have an interest rate which brings them together and we get funded. And there's been an argument that up until, I would say actually, up until about 2015, 2016, when truly markets took off, broke away from the mooring, the gravity which had been the highs of the year 2000. And of course, the highs of 2007. So the two great recessions of 2000, 2003, 2008, 2011. One of the problems had been that the genius of the interest rate, which brought debtor and creditor together, that level was too high, that you cleared, that the debtors had no choice, it was the funding. But the funding had too much of a reward to the creditor, almost like an option seller. The creditor was selling options that the debtors had to buy. And it was a protective option for the creditor regarding inflation. The creditors wanted an inflation premium, which was arguably greater. It was mispriced versus the actual path of inflation. So the risk premium for lending was inflated. And that led to a transfer of wealth from the debtor community to the creditor community. And at the sovereign level, China pursuing a policy of surplus savings as implicitly creditor. And then lending the money, almost like vendor financing, to the deficit nations. And what people fail to grasp is that by implicitly targeting surplus savings in China, in a, I was going to say landlocked, but in a global trading system, and with the size of China, that its autonomous decision domestically to target high and surplus savings meant that in America, it was an assured thing that America was effectively importing the opposite, that China had targeted surplus savings, and therefore the US, in a system where the globally we have to balance, there's no surplus savings or deficit, that the US had to effectively negative savings, run down its savings, dissave. And China had been managing its exchange rate via lending to the American government. And again, at 10-year rates, which embedded too much of a risk premium for the return of inflation. And it was quantitative easing which sought to address that. And quantitative easing, by driving 10-year yields down so precipitously, took away the excess risk premium to the creditor. And by taking it away, you stop transferring wealth from debtors to creditors. So QE, an interesting policy which I've never really seen properly set out on that basis. I mean, let's have fun. From those levels, what did I say? 2006, 2016, 2017. I mean, 16 is a stretch. 13, yeah. You know, like 2016, you're 1870 on the S&P. Prior to the '08 crash, you were 100 points below that. So that, that breakout level, 15, 16, 17, tack on the compound rate of return, which is very high recently, 11.5%. And let's say something silly, but S&P could go to 10,000 before the fat lady sinks. Did I just predict that? Lots of finance. I was just going through some of my notes. And, the US markets were small. The value of US stocks was $15 billion in 1913. I love all that. I love history with numbers. So just before the outbreak of the First World War, the American stock market was valued or capitalized at the same amount of money as the British stock market. And maybe that was a big deal. That was the emerging superpower being capitalized at the same level as London. 1913. And fast forward 12 years, 1925. The US stocks have doubled to $30 billion. Doubled. Not a huge return, is it? And go 2 years later, 1927, the Dow is like 160. 160. I mean, looking at the 168, let's call it 170. Look at the charts. It was 150. The end of 1925. So it moved 20 points to 1927. Pedestrian. And the Fed is persuaded to do that interest rate cut. And the Dow just goes crazy. And so 168 in the middle of 1927, and it goes up more than 200 points. It more than doubles to 380. And it blows. Interest rates. And that's why I was having fun with the Twitter thread, Mr. SAP. And the amount of money, nitroglycerine, in money market mutual funds. When the Fed tends to cut interest rates, the recent experiences, they cut really low, and it chases that money out of those funds to seek risk. $8 trillion. We discussed that. We discussed again the $13 trillion, where there's a potential knock-in should interest rates fall. And that's a big if 10-year rates fall below 3%. That there's a reflexive force within the banking, the large American money center banks, that would effectively cause them to be chasing and buying new highs on 10-year treasuries. And quite a while back, I was saying I was very fearful of the notion that China could devalue its currency. And of course, very recently, I've been arguing, last week, I have been arguing that there's an inevitability that the movement higher in gold, which increasingly feels a little bit meme-like in the sense of I'm not sure it's happening for very obvious concrete reasons. Buyer begets buyer, reflexivity. I've tried to nuance that and try to, the astonishing size of what the astonishing the US factually, and I know that's a great challenge for people, but you got to live. You can't be a digital assistant. You can't hallucinate. I mean, I'm at my wit's end with super grok. It's just super infuriating. It hallucinates. Today it had durable goods orders as I was asking for the economic data. And of course, we had no durable goods orders. And so I had a fight with it. I was like, why are you inventing this? Oh, really? Sorry. It won't happen again. Yeah. I mean, it will happen again. You're lying, stupid machine. Who is lying? I love Elon, but he is promotional. The concentration of his Grok AI having being close to super intelligence. It cannot calculate compound annual growth rates, and it cannot tell me the day's major data releases. My prompts I work on my prompts. They're clinical. I put the prompt back in later today as I was debating on whether to do this. I am still debating on whether to release it. And I asked the same question. And of course, it came back with, well, the durable goods orders. And so I'd recommend you don't panic. I'd recommend you don't hallucinate. This constant, oh my God, Twitter's still driving me crazy. Hallucinogenic properties of Twitter. Doubts over the lack of an audit of the US gold supply. Does it have what did I say, 262, 266, 268 million troy ounces, 260 million something troy ounces? Better to just, in a world where there's so many unknowns, stick with that being known. And stick with the known figures for China's gold. Maybe they're out by 5-10 million troy ounces. Does not move the needle. But one of the amazing things is just how robust the US looks when it's finally in the hands of capable administrators who are actually seeking to extract every ounce of value on behalf of the US, the largest consumer market in the world. You want to play? Gonna cost you. Yeah, you want to play in the world's largest consumer market, the largest. You want to sell stuff in the world's largest market? It's called America. A Roman Empire that was not demanding tributes. In fact, the opposite. And the tariffs, that's why initially you don't want to like the tariffs, but then you view it as we're over here with contract law, respect for property, deep liquid markets, a central bank that bails you out. We don't largely discriminate. It's largely foreign capital that led to the overhyped chasing of mortgage-backed securities and the overvaluation of residential property in the early 2000s. If you went back to the 1920s, the curb lending, the using stocks as collateral and then lending money so that people could buy more stocks. The last 2 years of the run in the Dow, that was not US institutions, that was foreign capital. I could go on. Foreign capital is welcome. It's an open capital account. Open capital account. US is open. Did I see that the tariffs are running the last 2-3 months? They're running, was it $30 billion? Must check that. Yeah, I think 30 sounds about right. I mean, that's like almost 400 billion a year. Starts to make a difference on the deficit. Anyway, did I say S&P at 10,000? So again, we were saying you've got $8 trillion on the sidelines in money market funds. You've got this huge bulge of mortgages which were refinanced in the years 2020, 2021, and in which just no one's moving house. Equity is locked up, tied in, nothing's happening. And all the ancillary activity when you move house, none of that is happening. Housing turnover, really, really low. The Federal Reserve is cutting interest rates. Oh, and let's do economic statistics for the day. Let's do the Texas. And actually, I think this is my second Texas manufacturing survey since I've been doing it. Comes out right at the end of the month. So I think we started this at the beginning of the month. So we'd have caught it for September. This is for October. And it wasn't it's one of these indices again. So below zero, you've got contraction, above zero, expansion. September was a bit stinky. It was -9. This one came in at -5, but production was a bit poorer. New orders were poorer. Employment was actually expanding, and prices were really expanding, really elevated. So again, back to the dilemma of the Fed. Why is the Fed cutting interest rates? But they are. And let's say they follow through. And, I've got a position in the asset portfolio, $10,000 on call option premium that the SOFR contracts for March 2027 will be trading at 99 or higher, which is Fed funds of 1%. And I'm not making this up. I'm trying to be playful in my mind. I'm trying to just speak into the void. I'm literally talking to myself. Because really the big debate is, this time last year, the Fed surprised all of us by coming in, and is it aggressively the right word? But I want to say there was 100, 150 basis points of cuts, as much as that, maybe 100 basis points at the end of 2024. And everyone went, where did that come from? And the result of that was a steepening in the yield curve, which is to say the 10-year sold off. Now, My thoughts, and again, this is really making things up, but my thoughts were that the Fed was alarmed at how the curve, which was flat, kind of 4%, 4% across all maturities. And it was having these parallel shifts lower and lower and lower. That's what happened in China. That is really unpleasant for the banks. And the Federal Reserve is both the regulator, but the kind of sponsor of the health of the financial community in America, the banks. And you want to be able to have access to deposit money, and you're paying cash money. You want that to be low. You want a steep yield curve. Steep yield curve allows you to borrow at 1 and lend at 4, 5, 6, 7, 8%. And that's your profit margin. But if the curve is coming down and there's compression and there's no difference between the maturities, there's no profit. So there's a bit of an argument that this time last year, the Fed was doing Paul Krugman, and it was convincingly kind of persuading the market that it was being reckless in cutting rates. And so the market went, well, hey, reckless Fed. And we went back to, I want to say we went back to 5% yields. Yeah, that's about right. We got a 10-year. 10-year was about 4 when they cut interest rates. And we got it, by about February of this year, they had it back up to about 480. The end of January or so of this year. So the Fed behaved recklessly. Why? Because, I mean, we were at 3.6% 10-year yields 2 years ago. And you're at 3.6 and dropping. You're really going into that environment where you might unlock what I think would be a huge economic stimulus from knocking in all that mortgage refinance activity and creating mortgage gains and seeing the housing stock turn over. And I think the Fed decided it didn't want that. Now, was that similar to the New York Fed, which effectively was the Federal Reserve? Was it similar to what has been regarded as a classic central banking mistake? It broke effectively the guardrails of the gold standard in the 1920s by sterilizing the inflow of gold. Let's try and unpack that. So in the gold standard, you run a trade surplus. You run a trade surplus because you got better goods and services, and you can produce them at a lower cost than the rest of the world. And economics wishes to reward that. It's like, well done. And so you get a transfer of wealth from the rest of the world in the form of their gold reserves. And those gold reserves, we've been talking about the fairy dust, the base money, the high-powered money, M0, the cash, the notes and coins, but the reserves of the private sector banks held at the Fed. And that money should be boosted with the gold coming in from the trade surplus. And that high-powered money those additional reserves allow the banks to create more and more assets, which are loans, which is credit, and which is typically very pro-cyclical and very positive for the expansion in the economy. And the Fed said, no, we're not having that. We're already growing too fast. Now, the whole notion of the gold standard is, but we want you to grow faster. We want your incomes to be lavish, so such that your demand for overseas goods and services becomes greater, that you become less competitive, so that your trade surplus doesn't grow like a tree and grow to the sky. I mean, trees do grow to the sky, but they have a limitation. And the limitation would be that the release of this high-powered money, which would be multiplied several times over to become M4, broad money, which would expand the economy, would create inflation. But in doing so, it would create more and more total demand, and therefore the demand for overseas goods and services would expand. And you would be creating an impulse, and you'd be creating a positive impulse. You'd be seeking to restore balance to largely continental Europe. You'd be giving it demand, economic demand. You'd be putting credit back into their system and allowing them to have economic recovery at your expense, but from a very high level. And that didn't happen. Could it be that the Fed, in pursuing, in incredibly looking very reckless a year ago, and taking the 10-year up to 4.8% by January, February of this year, was making the same mistake? That America should have boomed this year with the release of the mortgage refinancing effect on the economy. I don't know. Be one for historians in the future. The bigger question is, so they're going to cut this week, and they're going to cut again before the end of the year. As yet, there is absolutely nothing in the pricing of the March 27 contracts to suggest any more credibly reckless cutting of interest rates. We shall see. But yeah, the big unknown, and here we are, and we're running a 25% NEV position in the TLT, is, do the bond prices sag? Does the Fed come out and again claim to be recklessly or credibly reckless? And again, we can look at things. Where was the TLT trading vis-a-vis, let's say, its 1 year moving average? And yeah, it's very similar setup. The TLT had rallied from the low 90s, 91 or so, to about 101. And then all this credible recklessness. I mean, at those levels, it was beginning to trend above the 1 year moving average. And then this credible recklessness of the Fed knocked it back again. So our TLT is the big risk factor in the portfolio this week. What shall we do? What should we do if the TLTs trade below? Where are they? They're 90, 91. If they trade below 88, are they heading back again into the low 80s? Don't know. We'll have to watch. Maybe we just the one you're moving average is 89. Maybe a close below the 89, you sell it. An S&P at 10,000. Imagine fiscally, those tariffs are bringing in $500 billion a year. $500 billion a year. I must get that function on my computer where I can do the calculator. Oh la la. I hate talking and trying to do things at the same time. I'm breaking my rules. 0.06 times, I don't know, 28. What's the size of US economy? Yeah, I mean, so the deficit must be about 1.6, $1.7 trillion. And maybe you're running tariffs of $500 billion. So the deficit could be going down. And then imagine that large component of the deficit is the interest expense. And if the 1-year treasury yields are falling because of the Fed cutting interest rates or otherwise, and let's say we've come down from 5.5 to 3. Purportedly, I'm saying, well, if they go to 3, there's another big reduction in the deficit. You've got that mortgage refinancing unknown. You've got that potential risk shift in money market funds. If gold stays at these levels, the dollar, if you want to, which is not my favorite argument, but if you want to bring gold as a monetary metal and try and make an assessment on the recklessness or otherwise of America, it seems less reckless. And you're probably, a third of the way through re-onshoring. That and the sovereign sponsorship deals you've done with creditor allies, again, debtors and creditors. The debtors turned around and said, we own the future. Do you want to share it with us? Great, then you're going to have to take the knee. So, Japan, the Saudis, the Arab nations, the rich Arab nations, being promised economic equity for the financing of the enormous build in North America. I mean, just looking at the semiconductor stocks, they are ripping. They are ripping higher. And that looks like they're ripping higher on real growth, real physical expansion in growth. In data centers, they're just running out of capacity and need more. That's all I hear. And I had this awful experience. I have the 225 charts of the Nikkei, and it is wonderful. I was saying to you, I love looking at charts. Again, like a history book. And oh my God, I'm going to drive it into you. There's such a recurring, powerful signal where you get compressions and then you break out and you go higher. You go much, much higher. And I didn't record it. I think I'm recording this. Anyway, so there you go. Like crazy garbled guy sits in the room in the Caribbean looking out the window and all he sees is the reflection of himself staying back going, what are you talking about? I do like watching or reading about takeovers. Takeovers when companies reveal their intentions a little bit. It's a revelation of some sorts. And the frustration is we never get enough information from the journalists. What did Ayn Rand say about journalists? That always seems appropriate. Yeah. In the Ayn Rand world, journalists who've abandoned intellect and moral integrity to become propagandists for what Anne would call collectivism, the deceit of the woke era, which is now behind us, which is really good. Anyway, so the abandoning intellect seems very, very appropriate when it comes to acquisitions, because there's just so much the inquiring mind could ask, and they don't. I mean, why don't we get the enterprise value to sales metric? Why don't they tell us the EBIT margin and the average 5 or 10 year EBIT margin for the business that's being acquired? You know, is the acquiring company paying 2-3 times revenue for? I mean, let's think about it. You know, normally, so if we're talking about nominal GDP growth, nominal GDP growth, 6% nominal, you get a 10% EBIT margin business, you'd be paying probably 1.5-2 times revenue. And your return, unless you're going to do something dramatic with it, is kind of mediocre. If it's growing very rapidly, 15% compound, so it's doubling earnings or doubling revenues every 5 years. Maybe you're paying 4 or 5 times sales, but let's have that conversation. You get none of those conversations. Anyway, Novartis splashed out. How much did it splash out? 12 billion, 12 yards in cash. I think Novartis is, I think that's 5% of the total capitalization of Novartis. It's not a huge deal, but giving away 5% of its net worth to buy a bioscience business. But 12 yards is a lot of money. If that was an IPO, that'd be one of the biggest cash calls on the market for quite some time. And it was buying, God knows what it was buying. Avidity. And they make antibodies or proteins, and they use it for the body to deliver a cure, a mechanism. And the cure or the mechanism is in this RNA, these terms, acronyms that we learned from the dreaded pandemic. But it's short strands of DNA transported through the body by proteins. And the exciting thing for me, for humanity, is that this delivery mechanism is reaching further. It's reaching muscle. And that's a huge deal, because it's the kind of, it would seem as a $12 billion confirmation that the delivery mechanisms are going much further into the body than previously thought. Previously, you get it. You could reach the liver. The liver is the easy organ, if you will. But avidity has reached the muscle. That's all I know. I don't think they're buying a drug. I think they're buying a delivery mechanism. I like to think of it back in the day of the emerging internet and how you're going to do ADSL over telephone lines and how you're going to packet things. And it was going to be like 5-6 lanes on the motorway, and your little mechanism could jump between the lanes and move forward. And this is how you could accommodate so much data. Delivery mechanisms. So I thought that was interesting. And then of course what I do is I look for, I'm like, any stocks, who stands to benefit from this? And again, I've no idea, but the research threw up A. Archie, Liverpool, New York, ALNY, which itself is a pioneer in these antibodies, in taking these strains of DNA and pushing it into the body. And so the hope is that whole thing, $12 billion, 12 yards, coming of age. Who knows? I certainly don't know, but quite a decent chart on Alnilam Pharmaceuticals. But, oh my God, I must go back and try and record. Because it's such a killer when you do an hour of talking into the camera and you get nothing to show for it. I've been talking for an hour. I don't know if I've got much to show for it. I am not going to be crestfallen. I hope I do publish this. I hope you do hear it, because this will go on. This will develop. This is Monday, and we're going to do this again on Wednesday and Friday. And you will see that these are just scattered, random, mediocre ideas. But by the end of the week, wow, we could be scaling heights, or maybe not. No guarantees, no promises. This is Hugh Hendry. I am signing off on a Monday. A Monday buffeted. Thankfully I'm at the far, far, far reaches of that monstrous hurricane, which is slowly heading towards Jamaica. To my Jamaican brothers and sisters, hunker down. You need concrete. You need 4 walls of concrete. Go into your seat down, into your cistern, like where you store the water in the garden. Get underground, but get into concrete. It's a bit wild and stormy here, but nothing like what's heading to Jamaica. So much goodwill and great thoughts to my Jamaican cousins for the help. When you see that swirling, oh my God, when you see those satellite things of hurricanes, ooh la la. Over and out. Let's reconvene on Wednesday. Hugh Hendry, loving you.